Hello and welcome to Investment Insight, your clear take on the markets. Let's get started. Today, we're doing a deep dive into something really complex, the whole U.S.-China economic picture. We've got source material showing, well, frankly, contradictory signals. It's the kind of stuff that should make any investor pause. We're really going to look into the impact of these ongoing tariffs and also some specific high-pressure moves from President Trump's administration. So, our mission today, let's try and make sense of this. You've got China showing this massive, surprising trade strengths globally, but then on the other hand, there are these really worrying signs about how their own consumers are doing domestically. So which signal is stronger? And maybe more importantly, how should you navigate this if you're learning or thinking about investing?
Yeah, and what's really striking is the confidence. China's leadership seems to be projecting this idea that they can just outweight the US in this whole trade thing. They seem to believe, maybe a bit cynically, that their time frame for enduring economic pain is just, well, longer than Washington's political attention span.
That feels like a really high-stakes bet. I mean, if their whole strategy is basically waiting us out, what makes them so sure? What's this economic body armor they supposedly have?
It seems to come down to two main things. First, structure. They have this huge domestic market, right? And really powerful state control. That lets them shift resources around, subsidize industries, manage shocks in a way that's just, well, it's not possible in a democracy like the US. And second, maybe even more crucial, is how they watch US politics. They've seen President Trump make aggressive threats, but then, pull back or soften things when the stock market tanks or when key groups like farmers really start feeling the pain.
Right, and the sources pointed to a perfect example of that just recently. This threat of a huge, what was it, 100% additional tariff?
Yeah.
Super aggressive, and then boom, reversed basically overnight, just one day later last week.
Exactly. And that specific turnaround, that's like gold for strategists in Beijing. It kind of confirms their view that the U.S. reaction is driven by short-term politics, whereas their goal, China's goal, is much longer term. They want tech self-sufficiency. They want to diversify trade away from relying so much on the U.S. They seem willing to take a hit now if it helps them down the road.
Okay, so that's the theory, the strategy of endurance. But confidence needs data to back it up, right? Let's talk about the strong part, that export engine. Because, kind of surprisingly, it seems like it's holding up really well. Where are they actually pushing back against the tariffs successfully?
Well, the latest trade data we saw for September really showed this. It blew past what the market expected. Pretty impressive resilience, honestly, despite those tariff walls. If the whole point of the tariffs was to cripple China's global manufacturing power, well, this data suggests that hasn't happened. Not at all.
Yeah, I think the really key detail there was the trade diversification angle. We kept hearing tariffs would isolate China, but the numbers seem to show they just found other buyers.
Precisely. I mean, sure, exports to the U.S. definitely dropped. That part worked as intended. But China managed to basically make up for every lost dollar in U.S. trade by boosting sales elsewhere. Exports to ASEAN countries, that's Southeast Asia, and, this is important, to the European Union, they grew enough to completely fill the gap left by the U.S.
Wow. That shows some serious ability to redirect things.
Yeah.
It means their sheer manufacturing scale and cost advantage are still huge levers for them. They can pivot fast, undercut local players in new places.
It almost looks like they used the trade war as a catalyst to push harder into Europe and Southeast Asia.
Okay, so here's the puzzle then. Exports are strong, giving them that resilience. Maybe they need to outweight the U.S. But doesn't that whole endurance plan depend on their domestic market staying stable? Their own consumers picking up the slack. Is that domestic market actually holding up its end?
And that, right there, is where we see the potential weak spot. The Achilles heel, maybe. If confidence is the armor, domestic consumption might be the soft spot underneath. We got a really clear picture of this from the Golden Week holiday, just back in early October. At first glance, the headlines looked great. Record numbers of people traveling, places were packed, people were definitely out and about. But the crucial bit was what they didn't do. Average spending per person. It didn't get back to 2019 levels, before the pandemic. The sources were pretty blunt. Crowds, yes. Spending, no. Wallets stayed pretty closed.
Huh. So it's like everyone showed up to the party, but nobody bought drinks. They all brought their own water bottles.
That's a pretty good analogy, actually. It captures the mood. This gap tells us the average Chinese consumer is feeling anxious, worried about their financial future. And it seems linked mostly to the shaky real estate market and worries about jobs, particularly for younger folks. It's not just being frugal, it's saving out of fear.
That anxiety has huge implications, right? Because it kind of undercuts President Xi's big economic plan, the dual circulation thing. That was all about relying more on internal consumption, less on exports.
Exactly. This weakness at home shows that strategy hasn't really taken off yet. China is still, structurally, pretty dependent on that export engine for growth and stability. If things get tough globally, they don't seem to have a super strong internal engine to fall back on. And that kind of puts a limit on how much short-term pain they can truly afford to endure.
Okay, so we have these two conflicting realities. A world-beating export machine that's diversifying like crazy, and then this nervous, cautious consumer base at home. What does this complicated kind of two-speed system mean for you, the listener, the investor, trying to figure out where to position yourself?
Well, the first thing, I think, is to avoid thinking in black and white. You have to be wary of both the extreme China collapse stories you sometimes see in Western media, and also that sort of blind faith in China's inevitable rise that you might get from, say, state-sponsored reports. The reality is messy. It's got these two engines running at totally different speeds.
Right. So you need a strategy that reflects that messiness.
Exactly. Focus on companies that are winning in that global pivot, the export story. And also companies winning from this shift happening inside China, the move towards value.
Okay, let's break that down. Winners from the strong engine first. If dodging U.S. tariffs and finding new markets in ASEAN and the EU is the big success, who are those companies? The ones really benefiting?
Yeah, you're looking at specific sectors where Chinese companies just have a better price-to-performance offering than the local competition in Europe or Southeast Asia. Think electric vehicles, BYD is a huge name there. Solar panels are another big one. And major home appliance manufacturers. These aren't just low-end goods anymore. They show China moving up the value chain globally.
Okay, that makes sense. Now, the other side, the nervous domestic consumer. If people aren't stopping spending completely, but just spending smarter, how do we identify that shift? What does smarter look like?
There's a key term in Chinese, gasumbi. It basically means price-performance ratio or value for money. It signals a really deep shift away from buying things for status or the fancy imported bag or car. Now it's more about getting the absolute best quality you can for the lowest possible price. Kind of like a Western consumer in a recession, switching from Whole Foods to maybe Aldi or Costco, getting the most bang for their buck.
So value is the new watchword, not luxury, for investors looking at China's domestic market. Where's that value-focused money actually flowing?
It's going to the companies designed for that. Think about the ultra-low-cost e-commerce players like Pinduoduo or Alibaba's Taobao platform. They connect consumers directly to low-cost goods. Also, you see success in low-cost lifestyle brands like Miniso. They sell trendy but cheap household items, and even domestic travel companies offering affordable trips because maybe people aren't taking expensive international vacations right now. These capture that nervous, it's still active consumer dollar.
Got it. So two clear paths, export winners, domestic value winners.
Mm.
But let's pull back for a second, big picture. If China's strategy really hinges on the U.S., specifically Washington, eventually backing down politically, what's the real main driver for investor sentiment here?
And that, I think, is the single most critical point for anyone invested in China-related assets right now. The source materials are pretty clear on this. The biggest swing factor isn't necessarily the latest Chinese economic report, not GDP, not inflation. It's U.S. political events, decisively.
Wow. So because Beijing's strategy seems politically calculated,
investors need to watch Washington more closely than Beijing for market signals. The direction for these assets seems tied directly to political wins and tariff talk. If the White House ramps up the pressure, markets tend to dip. If they signal negotiation or a softer line, markets tend to rise. It's almost that simple sometimes.
that really shifts the focus. It means U.S. political maneuvering acts almost like a leading indicator for these investments, while the Chinese economic data might be more of a lagging indicator, just confirming underlying issues.
I think that's a good way to put it. So the key things you need to watch are developments around U.S.-China talks, like at the upcoming APEC summit that's scheduled for late October. And listen closely for any changes in language about U.S. tariff policy, that political wind. Right now, it feels like the strongest force pushing this market around.
Okay, this has been super helpful in sorting through the noise. So the core takeaway seems to be China's got this strong armor of robust, diversifying exports. But it also has this vulnerability, this Achilles heel, of weak domestic demand, which seems driven by real consumer anxiety about finances in the future. An investment strategy has to account for both of those conflicting speeds. So here's a final thought for you, our listener, to chew on. We see China proving it can adapt externally, right? With that trade diversification success in the EU and ASEAN, what kind of internal fundamental structural reform, something more than just slogans, would the Chinese government actually need to tackle to fix the root cause of that consumer anxiety and really get that dual circulation engine firing properly? Something to think about. Don't forget to subscribe and hit that like button.